Let's start with how the portfolios have done last month. So starting with coffee can. So if you look at the 1 month return, the fund has delivered a very strong return of about 4.2%, compared to the benchmark of about 1.4%. The performance for the last 3 and 6 months has also been fairly strong at about 13.7 and 19.8% respectively. If you look at the top performers in the month of August, it has been led by PB Fintech, KFin Technologies, and Bajaj Auto, with all of them performing more in double digits in terms of returns. The bottom performance has been account of Pidilite, Kotak Bank, and Avenue Supermarkets. If we move on to Good and Clean, the Good and Clean month has delivered a return of about 2.8%. Again, it's been a good alpha generation of about 1.8%. For 3 and 6 months as well, the returns have been fairly strong at about 19.6% and 28.9% respectively. If we look at the top performers, Trent, Ajanta Pharma, and Lupin have been the top performers with double-digit returns in August 2024. The bottom performers have been Aarti, Balkrishna, and Aegis Logistic. Aegis Logistic, one needs to remember, has already delivered 57% return in the calendar year. So to that extent, it's mainly correction or profit booking, which would have resulted in this kind of a decline. If we move to emerging giants, the 1 month performance has been about 2.6%. Again, an alpha of about 1.5% in the last 1 month. The 3 month return has been close to 19.8% versus 13% benchmark. The 6 month return obviously looks a bit weaker at about 14%, mainly on account of the month of March, which was a bad month for the fund with a negative 8% return. But since April, the performance seems to have come back, and thankfully, post the elections, the performance seems to have improved a lot as quality has come back into focus. The top performers in the month of August has been Tips, Safari, and Home First, with double-digit returns for each of them. And the bottom performance has been by Neogen, TeamLease, and Orient Electric. Moving on to 10x. So for 10x, it's been a stellar month. 1 month return has been almost 5%, and it's been an alpha of almost 4% as compared to the benchmark. The 3 month return and the 6 month return has also been in excess of 20%. So it's been a very strong track record for 10x as far as 1 month, 2 month, 3 month, 6 month return is concerned. And if you look at the top performers, it's been led by Trent, Safari, and Lupin. Again, all of them reporting double-digit returns. The bottom performers have been Aarti, Aegis Logistic, and Metro Brands. So let's move on to the topic of this webinar, which is our newsletter, Numbers and Narratives. So I'll invite Siddharth Bothra to take this section. Siddharth, over to you.
Thanks, Bhargav, and good evening, friends. So, in this newsletter, the September newsletter, we decided to discuss on this topic, which, a lot of people talk about, but I think the nuances of both this subject is lesser known. So the topic for us was numbers and narrative. Essentially, what we tried to highlight here is that you look, as per Professor Damodran, in his book Narratives, Numbers and Narratives, the story of value of a growth story. So here, what he talks about is that there is a constant duel between a numbers person and narrative person, and he goes on to say that invariably most investors are either one of them. Like they always have a tilt towards either being a numbers person or being a narrative person. And he's given many examples in his book where if you were to take that test, which we have also highlighted some of them in our newsletter for September, that it becomes very clear whether your bent of mind is more towards being a number investor or a narrative investor. And the other thing that he rightly points out is that both these always think that they are maybe maybe superior, and the other way of investing is a bit inferior. And theirs is the way to value a company, or theirs is the way to invest. But both has their own positives and negatives. So as the professor writes in his book itself, where numbers book by itself, if you just go by numbers and all, it can sometimes be very intimidating, right? But you can just lose the plot, because till you have a story behind the entire numbers, it doesn't work. Similarly, if you were to just make a story on a narrative, it's just a narrative investing, there what happens is we often just get into a fairyland, and we lose the bounds towards a story. So he talks about how we should balance both of them, and as per him, both is equally important. The reason we did this study is because when we talk of this market today, there is clearly many sectors or many areas like the valuations which somehow doesn't make sense. And that's because the narratives part of the market in many sectors, companies, is so strong today that the numbers are not able to justify. uh, so we are doing this in three there are three bullet points here. One is understanding, which I just spoke about. The other is there is clear frameworks which we can use to identify these false and improbable narratives. And the second point, third point is that the discussion on how to deal with these tough narratives, which is the most difficult one, being the go big macro narrative, which is what we think is in play in India. So by saying by go big macro narrative, it is like the narrative is not on a company specific thing, but the narrative becomes something like, say, there's a commodities boom, or there's a China boom, or there's a Japan story. Similarly, it looks like there's today an India story, and so in the bigger macro narrative, things play differently. Yeah, next. So this is just to kind of show that science kind of has shown that we have both sides of our brain behave have different strengths, like the left side and the right side. The left side of our brain is more a numbers side, which is to do with rational, logical thinking, being realistic, being precise, being a planner. Whereas the right side of our brain is more about the impulsive acts, the emotional, the creativity and artistic, the intuitive sense that you get. And hence most investors, without knowingly or unknowingly, have a bent towards one or the other. Yeah, next. Yeah. So here, now we come to the frameworks by which, we can kind of deal with this particular thing. So as I mentioned, the problems with going with the narrative flow is that, you can quickly go into a fairyland where you make a big story. And, while stories need not have boundaries, but, when you talk of stocks or companies, they need to have boundaries, because all companies need to abide by this iron triangle of valuation, which is essentially the three aspects, which is the growth, the risk, and the reinvestment. So what we mean by that is that what would typically happen is that if anyone were to just talk about a narrative, and he's not going much by numbers, his idea would to kind of extend on one thing and not account for the other. That he would just talk about growth and not talk about how, when a company grows faster, he would need more reinvestment, and how the risk is simultaneously increasing. So the point we are trying to make by this iron triangle of valuation is that the moment you talk a high growth, there is also a contrasting thing happening, which is risk is going up and the reinvestment requirement is going up. So which brings down that value of growth. Similarly, if you're doing, lowering the reinvestment risk and lowering the overall risk, then, even with a modest growth, the value of a company could still be very high. So this is one of the first tests that, you should put all the narrative behind. So whenever you have a narrative, like whether it be with regard to a capex or with regard to what can happen in India because the per capita consumption numbers are low, or how far behind we are in terms of with comparison to developed countries and so on. So, these are the three questions to ask as to, in terms of growth. So are we investing enough? What would be the reinvestment requirement? What's the complexity, the detail there, the uncertainty and the unknown? And then understand the biases and perception. Once you do this entire thing, you will be able to kind of bifurcated between the value coming from what is there currently, and how much is the macro narrative leading to the value that a company is currently quoting at. The next one. And then the most important test that you should put each story in is the what they call is the 3P test, which is starts with, is it possible, is it plausible, and is it probable? If you look at the exhibit, in front of you, the left hand starts with something like cannot assess. So any story you hear, the first question to ask is that, is it even possible? And this could happen, but you are not sure whether this would happen. So these things are more like a option value thing, and you really cannot assess the value of such stories. So the value of such stories would be very low. So the way to think about it is that you think that, some story which you are not even sure will happen, but say hypothetically, if someone is suggesting that something like this could happen, then, the value you give to it, you should multiply it with a very, very low probability of that happening. And the answer you get is the actual value. So you value it like an option, just the way you value an option. The second part, when it starts getting a bit more interesting, is when you think it's plausible. That is, you cannot say that, it's completely impossible, but there is some chance, or the probability of occurrence is low. But the story or the narrative that someone is telling you is something that you think is plausible. So the valuation response to such things should be that, you show as expected growth, and as I was mentioning above, you adjust it for the risk and the return expectation. So the value will increase with the size of the market and your firm's competitive advantage. So this is something which you can see more positively. But the final thing which you should, like, this is the segment where if a company falls, you should only think about investing when you have more and more company in the third bracket, which is it probable? So when you have a story and think the probability of that is increasing or very high, though that is a story where you can actually do the numbers, assume what could be the numbers as you go ahead in the base numbers, and then with these firm cash flows or things which you can believe in, you can value a company more convincingly. So the two frameworks we talked about till now, one was the iron triangle, where first understand that in any story there has to be three elements. There has to be, like, there will be some growth, but along with growth will come the reinvestment, and along with it will come the risk element. And then you pass it through these 3P test, which is whether it's possible, plausible, and probable. And the prudent thing to do would be to kind of ignore a lot of the stories which fall within the possible, but doesn't even have elements of plausible or probable, and buy more companies which are in the third one, which is that the narrative or the story you are hearing is probable, and this is something that you can value. Now, next one. Another thing that he mentions about is that people keep talking about stories and so on, and this is a graph. This is a exhibit that I've discussed with you earlier also when we talked about established coffee can companies and future coffee can companies. So what we see here is the what we call the prospective coffee can company. So what we see here is that there are 6 stages that a company goes through, from a startup to a young growth to high growth to mature, stable, and decline. So if you look at the last, the below, the table, the line right below this exhibit, which talks about mostly all narrative. So when a company is in a startup stage, typically, everything is about being a narrative. Even when they move to something which is like a 3-4 year or a high young growth company, it is still more narrative and numbers. So today, if I were to tell you a story in a company which is recently listed, then you have to believe that okay, these are young companies, so I have to give some weightages to narrative, and narrative could be a larger component of my overall value. But assuming the same thing happens when you are nearing say a matured company or a high growth company, there you should be very skeptical of someone trying to talk about narrative, because as the company moves to stage 4 and stage 5, it becomes largely about numbers. So in stage 4 it becomes more numbers than narrative, and in stage 5 it's all numbers. So, if you think that an ITC or an HUL is a matured company, then, in those companies, don't buy these stocks based on narratives, because, they have reached a stage where your investing decision should be made entirely on numbers, not on some story that, this will happen or that will happen. Those things will typically not work when a company is in this life cycle. Next one. And this is where we kind of add up everything that we talk about in this note. And this is the most important thing, because this is how we see the whole situation arising here. So I will quickly explain what is this. So as I mentioned, today what we see is that there is a macro narrative in India. So why is this third point of a macro narrative important? Because professor, in his book, the numbers and narrative, what he talks about is that typically when a narrative is about companies, it's easy. That is, whenever the narrative is micro, company related, you can easily bifurcate the value coming from purely based on numbers, and how much is coming from a macro tailwind. That is, the economy will suddenly the interest rates will fall, or some story about some macro part of it. But when stories become macro, it becomes very, very complex, and typically they break away from fundamentals. And these are stories which can go on for decades, and these are stories which typically do not follow the typical micro thing, where it's much easier to kind of understand the factors which are impacting it. The macro stories are impacted by so many factors, and it becomes a much more complex game. This is, I think, very similar to what we saw when there was a entire bull rally in Japan, or when there was a big bull rally in China. So the China story itself was there. Then we had much earlier we had a Japan story, then we had an emerging market story, then we had a China story. We think similarly India is in a very strong position today, where India is almost emerging as a Tina factor thing, kind of a thing, in the sense that this is a country which gives you a very large market. It's a very large economy. This is a market where you have a very large demography is in your favor, and this is a market which has democracy. And so all the things which you look for, which is a large domestic market, a scale, a country where per capita income is very low, and likely to result in sharp increase in consumption as the per capita income increases. And this is a market which gives you political stability. So in all aspects, when you look at it in detail, whether it's the GDP growth rates, whether it's through the demographic lens, whether it's through political stability or the geopolitical positioning, India seems to be standing out. And this is one of the reasons why, when you look at in terms of the premium that India is getting compared to the emerging market or the other markets, or the kind of premium the overall market is trading. So if you look when a macro narrative is there, then what happens is the kind of bull rallies across. So today, if you see, the bull rally is very broad based. I can't think of any sector today where the bull market is not impacting, whether it be even sectors which have which one would have never touched, whether it be some agricultural sector, or whether it be some commodity. Everything seems to be impacted by this macro narrative. So what we have done here is we have divided it into 4 points. First point is India most promising economy and market. Then the second macro narrative in India is the domestic financialization story. The third narrative is that India will emerge as a manufacturing hub, the China plus one story. And the fourth point is the valuation as to how they kind of add up. So let's start with the right side. Here what we have done is we have kind of shown how the timelines are different for each of the narrative. While the first narrative we talk about, which is India promising economy and market, is a decadal kind of a narrative. So the timeline here is decade, and as we come down, it becomes years. So some of these, decadal themes are structural, whereas as you go down and down, it becomes cyclical and mean reverting. So a valuation is more a cyclical and mean reverting trend, whereas many of the other points are structural. So we have gone in depth in discussing on each thing, and while we have put down the narrative, we have pointed out some aspects which we think one should be cognizant about. So first is obviously India enjoying dinner factor, fastest growing, one of the largest and under-penetrated market globally. But on the other side, couple of things one need to be looking at is that India is benefiting in such a big way, being a TINA factor, because one of the largest economy, which is 20% of global GDP, which is China, seems to be in a strong down. The economy seems to be struggling. But as and when that economy recovers, it could pose problem, because the valuations there are, like, I would think currently around 30-40% of what India is trading at, and the valuations are significantly more attractive. The only thing which is lacking is the overall outlook, the growth. So if there's any recovery there, it could challenge some of the benefits India is seeing. And then we come to the second one, which is the domestic financialization story. In the first point, I am not even going to other aspects, like one of the reasons India is enjoying this is the political stability, the lot of other benefits India sees. So our political, on the terms of political strength, it's not today as strong as it was till the last before this elections, because to some extent, you don't have a single party majority here. So there is always a black swan kind of a risk coming, when you have this kind of a coalition thing. So to some extent, it's not as strong as it was 5 years back. Now coming to the domestic financialization story, you have a rising financialization of household saving. You have institutionalization of equity ownership, where mutual funds as a percentage of equity ownership is continuously increasing on the back of very strong inflows from SIP, and even otherwise rising individual investment share of holdings. But on the other side, some of the things one need to be careful about is that when you look at our household exposure to equities, today we are very similar to where we were in 2007-8. So as a percentage, it's moved up to around 35% of the total financialization investment. So this is one thing. The other is a lot of the money coming in recent time are thematic NFOs. And the issue with thematic NFOs are that very quickly things can turn either way, and then they can actually act as a from a tailwind to becoming a headwind. The third part is that the household savings trend is declining, because the income growth is to extent been lagging in recent times. Your employment generation has been more in agricultural than in manufacturing and so on. So those things are impacting a bit, and the equity boom we see benefits a very small part of the overall population. So that's something to take care note of. The third point being manufacturing hub. Now, this is something where we are almost neutral to maybe a little bit negative, because the target of increasing GDP to 25% by 2030-31 we seem to be behind because in the last year we actually saw manufacturing GVA as a percentage to overall manufacturing as a percentage of GVA actually declining, and we are perhaps at one of the lowest point in the last 20-30 years. And the employment generation, when we look at the pure numbers that comes out, does not seem to corroborate this view, because more the growth is more still driven by agricultural side rather than on the pro private sector employment side. And lastly, the valuation, as to how to look at near-term trends, which is valuations which are cyclical and they keep mean reverting all the time. So the narrative here, why people think this high valuations should sustain, one is obviously the fact I told you, that there's a very strong India macro narrative, and India is a TINA factor. The other is the growth and improved balance sheet justifies this valuation premium. People are of the view that the growth in the last 2-3 years have been stronger, and hence the balance sheet have got delivered, and hence this premium is justified. Our growth, when you compare it to other EM countries, is significantly higher, where growth for other emerging countries is a negative, or very very low, in single digits. Whereas when you talk in terms of corporate growth, PAT growth, we have averaged more than 20% in the last 2-3 years. Then the other point is obviously the sustained domestic flows, which will support valuation. So the negative things on all these three is that valuation multiples are now in many cases higher than any peak that we have seen. Our market cap to GDP is at 150%. Our P ratios are close to the earlier peaks we saw. When we take numbers like overall SMIT to overall market cap, it's one of the highest. And most of the numbers, you would look at it from a valuation angle, would justify that we are close to or higher than the earlier peaks. And then what could cause this harm is the last point, which is growth. PAT growth, which was very high. So when you look at the last 2-3 years, the top line growth has been in the band of 10-11% to 9-11%. But the profit growth has been very strong, because we saw a very strong margin improvement over the last 2 years, which made PAT growth more like a 20-25%. But as we move ahead, like in the first quarter, growth for Nifty or the overall market has come down to between 4-6%. And top line growth has more or less remained where it was, which is single digit, higher single digit number type. So moderating, if the growth PAT growth also starts moderating, then you will like some of the levers, as I mentioned to you, for justifying high valuation was that growth is very high, we are growing much faster, so that will go away. And I think this high valuation in selective pockets of the market or selective sectors would be difficult. So this was our thesis on our study on narrative and numbers. And what now finally, what is our summary? So our summary is that the markets post COVID for the last 2-3 years has been driven more by sectors which are not known for value creation, sectors which are very high beta, sectors which are very deep cyclical, and maybe sectors which have recently been more driven by narrative. Our sense is that is now getting into serious pressure. We're already seeing them correcting, and we think this would further accelerate from here. And we think there is a major move, the smart money move, we think is happening towards quality, and also towards large cap, where we see more value. So our deduction from this entire study is to abide by what Professor Damodaran himself kind of recommends in environments where we see a macro narrative happening, which is that any company you see, you value it in a way where you first figure out what is the micro valuation, micro value for that company, that is, what is the intrinsic value for that company, and then understand how much of value currently you're giving because of the tailwind or the narrative being built around, say, some of the macro factors. And in any sector or companies where you think that bulk of the value is coming from narrative rather than the inherent intrinsic value of a company, is something we should strictly avoid, because many of these macro narratives change very suddenly. And then, there is this famous saying that these kind of things don't stop at a time correction or a very slow grinding these are typically very violent corrections or very sharp corrections. So we think that, if you look at the last 3 6 months, which is also to some extent reflected in our performance of our funds, we are seeing this move towards quality and large cap happening in a big way. We think this move towards quality will only accelerate from here, and we are just at the beginning stages of seeing these benefits. And from that perspective, we think this trend is just picking up. And so our recommendation is to move more towards quality and large cap from here on. So that's my summary on the entire thing. I'll leave it to Bhargav now for macro and micro. Over to you, Bhargav.
Yeah, thanks, Siddharth. Yeah. So to start with, if you look at the private sector, the capex, which has been struggling for a while, FY24, however, has been clear, and there is some green shoots finally happening as far as private capex funding is concerned. So if you look at data, for FY24, the private sector, the capex funding has been to the tune of rupees 6 trillion. And it's a massive improvement in terms of YY growth. So the print shows a growth of almost 61% on a YY basis, which is a very encouraging number. And it seems like that finally the private capex is showing signs of improvement. The key drivers amongst the private sector seems to be infrastructure and metals, which have accounted for as high as 65% share of private capex sanctions. So clearly, good signs as far as private sector capex is concerned. Moving on. In terms of the real GDP growth, as far as the first quarter is concerned, it was a sort of a tepid quarter with the print coming in at about 6.7%. To some extent, it was sort of expected, given that it was an election quarter. If you look at the breakup and if you look at government consumption, shows a minus 0.2 sort of a growth number. And that is what has actually impacted the overall GDP growth. It is that the private sector has shown good signs of making a comeback. So if you look at private consumption, it's almost up 7.4% as far as YY growth in the first quarter is concerned. In fact, manufacturing growth also accelerated sharply to about 7% from 5% in 1Q FY24. So net, it looks more like an aberration, the 1Q GDP growth. We don't believe that 6.7% can be the number to be looked forward to as far as full year FY25 is concerned. And I think from the second half onwards of this financial year, you should see a slight pickup as far as the GDP growth is concerned. Moving on. In terms of rate cuts, obviously the expectation in terms of rate cuts from the Fed is now rising a lot. In fact, the market is pricing in almost 100 bips rate cut by December 2024. So clearly, some of the buoyancy in the market seems to be on the back of this rate cut expectation. Any expectation which is lower than 100 bips could be taken a bit negative by the market. But if it is in the range of 100 basis points, then we see as a big a positive or a negative surprise. Moving on. In terms of overall earnings growth, obviously FY24, as Siddharth did highlight, was a very strong earnings growth for the Nifty with almost a 25% earnings growth for the Nifty 50 companies in FY24. Similar growth in FY25. The reason being is that FY24 was a year where there was a significant margin expansion. So if we look at consumer discretionary as a sector, it was a big contributor to the overall on Nifty, with consumer discretionary companies in Nifty growing at about 47%. Obviously, the margin tailwinds will no longer be applicable in FY25, and hence FY25 will be more in line with the revenue growth. So we're looking at 12.2% in terms of earnings growth for Nifty 50, which is a significant deceleration compared to 25% earnings growth in FY24. In terms of earnings and valuations, if you look at the Nifty level, the 1 year forward, the P ratio of 21 times is in line with the long-term average of about 20.4. If you look at price to book, obviously it looks expensive at about 3.4x. But the highlight of the year has been that the return on equity for the Nifty at 16.5% has been the highest in the last decade. So it's not that the valuations are rich without any fundamental drivers. The fact that the return on equity for the Nifty is at 16.4 and largely led by banks clearly points to the fact that it's being backed by fundamentals, the current valuation. And had it not been such kind of re-rating, then obviously you could have sort of questioned the current valuation. But the fact that the return on equity is also the highest in the last decade suggests the fact that then the valuation at which the markets is trading at seems to be justified as well. So let's move on back to Siddharth Bothra. He'll sort of take you through the changes which he did in Coffee Can over the last 6 months, and resultantly the fund has actually done very well in the last 6 months. Over to you, Siddharth.
Thanks, Bhargav. So essentially, we just wanted to kind of highlight why we think in the current environment, Coffee Can is one of the most promising fund that we can recommend from our side. The reason being two, three. One is when you look at Coffee Can, it's one of those funds where we have say between 18, 20 stocks, very concentrated kind of a portfolio, or majority is large cap. So we follow the SEBI thing where it's almost 80-20, 80% large cap and 20 would be mid and small. And the way we pick up is, as I had mentioned in our previous calls, what we did is it's a mix of both prospective Coffee Can and emerged Coffee Can companies. And so these companies are not only gives you the stability and the kind of resilience that you look for in large caps or funds like this, but because there is a 20 to 30% what we call the prospective Coffee Can companies, there is also a very strong growth and overall kind of not just about kind of proven or old numbers, but also what could be future Coffee Can companies. So to just give you a sense, in the last 9 months since January, like since me taking over the fund, what the changes we did, we bought 2-3 companies in the bucket of prospective Coffee Can. And actually, two of them, one was KFin, which was a recently listed company. And it was actually a small cap, but we said that, this is a company which will be one of the key capital market infrastructure company. And we needed to, have it in a thing where we call the future Coffee Can companies. So that stock's almost double for us. Even Zomato, which we actually ended up buying a bit low, the stock had already doubled by the time we bought. So that stock also has doubled from us. Our average price there was 135, 130. So that stock's also doubled from us. So two of the stocks, which is roughly 11% of the positioning we had, doubled there. Many other stocks we bought in that bucket, which also comprises of companies which are great companies, but maybe have for some moment kind of fallen, like the fallen angels kind of a thing that we call. So within that, we had also got Bharti Airtel. So that also has done very well for us, so if you look at the changes we did, which is roughly 50% of the fund, that would have generated, returns compared to what we had earlier, roughly around 24-26%. And now when you look at it since Jan, our alpha there would be around 5-6, even on since April more to like 4.5-5%. So the benefits of those changes have started to come in. Now next slide. Can we yeah. So the point I was trying to mention here is that if you look at the coffee can fund, we this fund's been there for a very long time now. So we have a history for this fund going back all the way. If you look at it, the first one is the EPS, the below one is the Ambit. Can you come to the next one where the performance is there? The performance one, please. Not the performance one. Yes, yeah, the coffee can, yes. So the point I was trying to mention is, if you look the returns from say CY 17 till 21, this fund typically, when quality was in favor, say like in 17 it was a 10% alpha, 10% alpha in 18, similarly 6-7% in 19, even in 24-5% alpha. 21 is the COVID year when we first started seeing some impact, and the next 2 years when this entire rally of deep cyclicals, some of the so-called narrative-driven stocks, those things impacted us. And as we seeing the benefits again turn towards quality and large cap, we think that we should again stand to benefit the way we had done earlier when this trend was in favor. And the when you look at the performance over 3 years or the very near term, you will see that the performance being weak. That's because of these 2 years. But as we move ahead and as the performance improves because of the move towards quality and this quality and large cap, what we will see is that it will negate these two periods, and it will start showing the benefit of the fact that over the last 10 years, bulk of the period we've had very, very strong performance, which is already reflected in our since inception returns, which is close to 18 and which is say 2% above the benchmark. But as we move ahead, we think this should do much better. Yes. So if you can come back to yeah, I just wanted to touch on this point once. And then obviously the benefit of being in a coffee can is that it's very low. The risk you take when you buy a fund like this is low. If you look at our beta, it would be significantly lower than the index. But when you compare it with other funds which are more laden with risk, there the beta would be significantly higher. So compared to that, beta is low. When you look at the maximum drawdown, that's the key thing to see. The max drawdown in an index use was 29-30%, whereas for our fund it was 17%. And because of these two, when you look at our Sharpe ratio, it's better. And then if you look at the broader numbers for us, while our earnings growth is higher, our ROEs is much better. And when you look at the peg, on a peg basis also, we are better than the index, this thing. And our overall holding is fairly diversified, with around 33% coming from financials, then information technology, retail, healthcare is around 9%. So it's a fairly well diversified fund. And even within large cap and mid cap, we have a fair diversification. When you look at both the small and mid, between them, we are close to around 20%, and with the large cap being the other 80%. So it gives you a good mix. Typically, a mix between 20-25 large cap and mid and small gives you the best risk adjusted return. So from that perspective, we would want to highlight this fund as something we would really push today. And we think the smart money is already moving more towards high quality and large cap. And this is a trend, which is reflected in some of our performance. And I would suggest that as this could be coffee can could be one of the ideal vehicles to ride that particular trend. So that's on coffee can. Over to you, Bhagat.
Yeah, thanks, Siddharth. So we're very proud to announce the launch of Ambit 10x India Fund. This is a dollar-denominated fund which is live now. So it's essentially for the foreign investors who want to sort of also participate in the India story. It's on an AIF platform, and the NAV will also be dollar denominated. So we're very happy to sort of address a lot of queries which many of our partners had, that where to invest if a foreigner wants to invest. So in fact, there are many NRIs who sort of were asking us to launch something in the gift city for them to participate in the India story. So now we are very happy to announce that the fund is live, and we would urge you to sort of contact our sales representative and flow in the dollars for us. Just a brief on the fund. So if we move on. So the philosophy of the fund is very similar to our 10x fund, which is the INR denominated fund. So the philosophy herein is to invest in companies where we are looking at earnings growing by 10x over the next 10 to 12 years. Obviously, on the capital allocation side, we put in a lot of weightage. People are aware about our greatness framework, so that framework gets applied into this fund as well. We obviously will select businesses that can navigate market cycles across various time points. So we will not be looking at investing in cyclicals. To that extent, the fund is all weather. And lastly, obviously, it will invest in companies with exemplary leadership. So either the companies will be market leaders or top three in their respective domain. In terms of the focus of the 10x fund, we are looking at sort of earnings growth in the range of about 19 to 21% as far as the CAGR is concerned. So that's how typically we are seeing that the earnings of the 10x fund companies will sort of become 10x in the next 10 to 12 years. So fair to say that we are expecting either similar in terms of returns in line with earnings growth, or maybe better if they go through a valuation re-rating. In terms of we've already sort of briefly discussed in the earlier slides, but just to reiterate, it is basically earnings becoming tenfold. Promoters selected will be such which are leading companies in terms of market leadership. Capital allocation obviously is a focus, and herein the main focus will be on operating cash flow generation. And obviously, as I mentioned, we will not invest in cyclicals, which means that it's an all-weather fund and also all-cap fund. So if any investor wants to invest across market cap cycles, which is large cap, mid cap, small cap, then sort of it's very similar to a flexi cap kind of a product on the mutual fund side. So this is our flexi cap offering as far as Ambit is concerned. In terms of the portfolio attributes, we are looking at a fairly diversified sort of a market cap bucket. So looking at 50% small cap, 38% mid cap, 12% large cap. We'll be investing across sectors like consumer discretionary, financials, pharma, industrials, consumer staples, specialty chemicals, etc., etc. If you look at the current Ambit 10x portfolio, and if you look at the performance since inception, we've delivered a strong performance of about 14.1%. In fact, the performance in the last 6 months as well as 1 year has improved materially, with Alok now heading the fund since the last 6 months. So we urge you to sort of ask your NRI investors to seriously look at this offering, and would sort of urge you to get in touch with our sales representative as